Welcome to Esquire Group's latest video. How are U.S. beneficiaries of foreign trust taxed? My name is Jimmy Sexton, LL.M. I am the founder and CEO of Esquire Group, and as always, I am your presenter today. Before we get into the video, if you like the content we're putting out, please take a second, subscribe to our YouTube channel. We'd really appreciate it. Before we get into the content, as always, a little disclaimer, a little CYA. This presentation is prepared for education purposes only. This presentation is not legal, tax, or any other type of advice. Each individual circumstances are different. You should seek legal and or tax advice to address any specific questions you may have. So let's get into it. What I want to talk about today is a very typical scenario of how U.S. persons can become beneficiaries of foreign trusts, and let's talk a little bit about what the tax impact is of being a beneficiary of a foreign trust for U.S. persons. So a very typical scenario is you have a non-resident alien parent or grandparent. So a non-resident alien individual, somebody who's not a citizen, a green card holder, or a U.S. tax resident. So you have this non-resident alien parent or grandparent, and they set up a foreign trust for the benefit of their family, so their spouse and their bloodline family descendants, so kids, grandkids, and so on for generations. And some of those beneficiaries may be U.S. persons or may become U.S. persons. A very typical scenario is you have a non-U.S. family and one of the children winds up marrying an American and getting a United States passport, or one of the kids may wind up living in the United States and become a U.S. tax resident by virtue of the substantial presence test, or they may get a job there and eventually a green card and become a citizen. So this is a very common scenario that you have non-U.S. based families where one or more of the beneficiaries is a U.S. person, or there's a likelihood that they may become a U.S. person in the future, and you want to make sure to do proper planning for that. So just to illustrate this graphically, right? So you have the non-resident alien, right? I know my drawing's not so great. And they put all the assets into a trust. It could be a foundation too. Foreign foundations are generally treated as trusts for U.S. tax purposes, so foreign trust foundation. And then you have, the beneficiaries, and some of them are U.S. persons. And how are those people taxed? And that we're going to talk about. Man, my writing's horrible. I'm going to try to get better at this. So first of all, let me say there are a lot of benefits for U.S. persons who are beneficiaries of foreign trusts if they're structured properly. So first and foremost, U.S. beneficiaries of a foreign trust generally have no U.S. tax obligations until they receive a distribution. That means no tax filing requirements, and also no tax payment requirements, right? So until they get a distribution, there's generally no tax obligations. If this trust is structured as a multi-generational trust, there's also going to be a huge savings on transfer taxes on generational wealth transfers, right? So usually when one generation dies and leaves the wealth to the next generation, there's an estate tax either levied on the decedent's estate or on the recipient, depending on what part of the world you're in. And those estate taxes can be quite high. With one or two generations of wealth transfers, the wealth can be gone. So there's a huge benefit to just keeping that wealth in a foreign trust and just having that foreign trust distribute as much income that the trust generates in assets as is necessary to support the current generation of beneficiaries, but not distribute the bulk of the assets. And the benefit is, as long as the trust owns those assets, you're changing the beneficiaries, but the assets always belong to the trust if you just distribute the income. So you save all that money on estate taxes, which is huge. And also, distributions of trust corpus are tax-free. Trust corpus is basically what was originally put in the trust. So let's say that foreign parent sets up the trust and they put $10 million in it. That's corpus. That $10 million can be transferred to the U.S. beneficiary tax-free. So distributions of the corpus out of the trust are tax-free. Distributions of distributable net income, DNI. This is current year income, retains its character and is taxable. So if a trust does make a distribution of net income during the year to a beneficiary, to a U.S. beneficiary, the U.S. beneficiary is going to have to pay tax on that distribution of DNI. But there's a benefit, and the benefit is that DNI that is distributed retains its character, right? So interest is taxed as interest in the hands of the beneficiary, dividends as dividends in the hands of the beneficiary, the same with long-term capital gains. Long-term capital gains and qualified dividends, for example, are subject to a lower 20% tax rate. And the beneficiary will get the advantage of that because the income retains its character. So distributions of income from a trust are taxable. Distributions of corpus are not. And the way to think about that is, going back to my example, foreign parent puts $10 million in a trust. Let's say that trust earns $1 million in income and then makes a distribution of $1 million. That $1 million is going to be taxed because it's income, as long as it's DNI, right? But if the trust makes a distribution of $2 million, $1 million of DNI and $1 million of corpus, the distribution of the $1 million in DNI will be taxed. The distribution of the $1 million in corpus will not. I have another slide where I'm going to try to draw a cool graphic for you to graphically depict the savings of transfer taxes, right? So you have the trust here, and then all of the assets are in the trust, okay? And then you have the beneficiaries. Let's say these are the kids, right? Because it's the NRA put it in, and these are the kids at current, right? His kids. And so all the assets are in here, and it's generating income, and the trust is distributing the income to the beneficiaries, but keeping the assets that are generating the income. So the beneficiaries, if they're U.S. persons, they're paying tax on that income, but when they die and their kids then get it, the trust is still the owner of the assets. So there's no generational transfer taxes on the transfer of the assets. What happens is the trust just starts distributing to them, and the same with their kids, right? So you hopefully wind up with a situation where the assets stay in the trust forever and never get vested in the beneficiaries. The beneficiaries just receive the income of that assets, and that way we can save a bunch of money on estate taxes. It's also possible that the beneficiaries don't need all the income to live, right? So we can just distribute what's necessary, and what is not distributed is kept in the trust and increases the value of the trust. Now, we've talked about all the good things, all the benefits that a foreign trust can offer in terms of U.S. beneficiary, but there are some negatives too. The biggest of which are distributions of what's known as undistributed net income, or UNI. This is a basically accumulated income. So if we go back to my previous example of NRA parent puts $10 million in a foreign trust, the foreign trust generates $1 million of income, but instead of distributing that income in the year it was earned, the trust decides to keep it and not distribute it. Now you have $1 million of what we call UNI, right? You have the 10 million, and then you have, that was originally put in by the NRA, now you have the $1 million of undistributed net income, the UNI. Now, when that UNI eventually gets distributed, it is not going to retain its character. It's going to be treated as ordinary income, right? So even if there was long-term capital gain or qualified dividends in that income when it was originally earned, when it goes out, it's going to be ordinary income because it's been mutated into UNI. UNI is also subject to a very punitive tax regime known as the throwback tax. And what the throwback tax does is it subjects UNI to the highest tax rate that was in effect in the year it was earned by the trust, not the year it was distributed, right? And there's an interest charge on that unpaid taxes if it should have been paid in the year it was earned. So when the beneficiary receives this distribution of UNI that's subject to the throwback tax, you have one, the income is being treated as ordinary income. Two, it's being subjected to the highest income tax rate that was in effect in the year that it was earned, and you're paying interest on it as if you should have paid that tax in the year the income was earned. And the result is it can wipe out distributions completely in some instances. UNI is not particularly beneficial, right? So a lot of times it's good to distribute the current income. I'm going to talk about some solutions to this UNI problem in a minute here, because there are some solutions to it. So within a trust, you basically have three potential types of sort of buckets that can be distributed, right? You have the corpus, the original 10 million. You have income that was earned but not distributed, which is your UNI. And then you have the distributable net income, which is the current year income. The current year income retains its character. UNI is subject to this throwback tax. Corpus, of course, is tax-free. I put in my previous slide that DNI, one of the benefits is that it retains its character. You can get this long-term capital gains tax treatment. Well, there's also a downside to it, which is if the trust owns a PIFC, a passive foreign investment company, which is essentially a company whose income consists 75% of passive income, or 50% or more of its assets are held for the production of passive income. This is essentially, think of a holding company, think of an investment fund, a foreign mutual fund. These are all generally going to be PIFCs, and distributions of PIFCs are subject to a very punitive tax regime. It's beyond the scope of this video. I'll throw a link up to a post on PIFCs that we have another YouTube video that will give you more information on how they're taxed. Let's just say it's bad. It's very similar to the throwback tax. So one of the bad things is, the PIFC income will also retain its character. I'm going to get into some solutions to this, like I said, on the next slide. Also, what we've been talking about now, up until now, is distributions from or the treatment of a U.S. beneficiary who's a beneficiary of a foreign discretionary trust. A discretionary trust is a foreign trust where you essentially say, the NRA, the non-resident alien that sets it up, says the beneficiaries are my wife and my kids. But the trustee gets to decide which one of those beneficiaries is going to get a distribution, when, and how much. That's a discretionary trust. You can also set it up as a fixed interest trust, where you say, okay, my wife gets 50%, each of my kids gets 10%. The problem with that is that usually if you're assigned a fixed interest as a U.S. beneficiary, you're treated as owning 10% of the trust. So, depending on the percentage owned, this can trigger filing requirements such as the FBAR, Form 8938, Form 5471 in the case of foreign corporations owned by the trust, and Form 8621 to report PIFCs owned by the trust. So fixed interest trusts generally aren't a good idea, in my opinion, when you're talking about U.S. beneficiaries. It's better to have a discretionary trust. So now that I've talked about some of the dangers for U.S. beneficiaries of being a beneficiary of a foreign trust, let's talk about the solutions. So as I said, throwback tax is on undistributed net income. Well, a solution to that is interpose a foreign holding company, right? So then you have the trust that owns 100% of the company, and all the assets that would have been in the trust are then held in that company. And so the trust doesn't have income unless that foreign holding company pays a dividend to the trust. So you can control the flow of dividends. So anytime you want to make a distribution, the foreign holding company pays a dividend to the trust makes a distribution, and then it's DNI and not UNI and not subject to the throwback tax. You just make sure you always distribute all of the net income, the distributable net income in the trust. This works very well. One of the dangers, as I said in the previous slide though, is that a potential holding company could be a PIFC. So if you have a PIFC that owns all these assets, and those assets are generating passive income or held for the production of passive income, there's a pretty good chance that holding company is going to be a PIFC, and when it makes a distribution to a dividend distribution to the trust that the trust then distributes to a U.S. beneficiary, is going to be subject to that punitive PIFC tax in the hands of the beneficiary. There are solutions to this. Sometimes it's as simple as doing an entity classification election and having that intermediate holding company treated as a disregarded entity. But not always, because sometimes the assets within the holding companies are PIFC'd themselves. So the point is of bringing these up, these are two possible solutions. There are other solutions. Careful analysis is needed of the assets that are going to be placed in the trust to determine how to avoid the throwback tax and PIFC status if possible. In my experience, it's almost always possible to plan around those, but you need to be aware that they exist and also be aware that there are solutions. As always, I hope this information has been useful and helpful to you. If you like the content we're putting out, don't forget to subscribe to our YouTube channel. Thanks so much for watching today. We'll see you on the next video.